So we have a typical full-class model would say have 40% for a family office, would have 40% bonds, 20% equities, 20% hedge funds, and then 20% inflation-sensitive assets such as commodities and real estate. If we look at the history of the alternative asset landscape, private equity really emerged as an asset class in the 80s with KKR and Kohlberg Kravis Roberts doing some of the largest buyouts and having KKR and Forrester & Little having significant returns. Then in the 1990s, we saw the emergence of pension funds, et cetera, allocating to private equity. In the 1990s, we also saw the emergence of hedge funds, and then in 2001, hedge funds were validated as an asset class when mutual funds lost 45%. And at that time, endowments really saw the benefit of investing in a hedge fund manager that can go long and short the market versus a mutual fund manager that is long only and is more correlated to the market. Another thing that we've seen a trend in the market is some of the largest endowments, such as Yale and Harvard, have started investing in hedge funds and private equity as of 1995. And we're going to get into this later in the presentation, but there's a clear correlation. A number of families try to mirror the asset allocation of a number of the top endowments, such as Yale and Harvard. So what is a full-class model exactly? The full-class model, which a number of family offices follow, was really comprised of every sector of the market. So you want stocks which have a positive response to economic growth, so they're profit sensitive. So if you're in a cycle in the market, such as the 1990s, where you're in a tech boom, your asset allocation is going to benefit from the economic growth and the technological growth and the innovation, and you're going to see an alpha in your return. Currently, we believe we're in an inflation-sensitive market. We think the Fed has printed way too much money in the United States. We think that we're going to see a tremendous amount of inflation. We think any real assets, whether that be oil, gas, gold, steel, water, real estate, are going to outperform the general market. There are those that say, no, we're in a deflation-sensitive environment, and I think this argument goes back and forth with people saying, no, we're in inflation, no, we're in deflation. So the great thing about the full-class model is if the deflation guys are right, and we are going to be in more of a deflation environment, then bonds and other, treasury bills and other bonds are part of the full-class model and are in a situation like 2008, I think bonds outperformed everything else. So if we're in a deflation environment or an economic decline, bonds generally outperform everything else. And then, of course, a full-class model also allows for us investing in hedge funds and other relative value, long-short strategies that can also achieve alpha. So the full-class model really achieves diversification across stocks, bonds, real assets, and long-short strategies. All of these strategies have advantages and disadvantages, but over time should weigh themselves out and allow for a 12 to 15% compound annual return over a 20-year period. So stocks, benefit from economic growth, benefit from growth in a cycle such as technological growth. The disadvantages are there can be volatility. We saw in 2000 in the economic crisis and in GFC, I think equities performed more poorly than many other asset classes. Bonds, of course, as we spoke before, are deflation sensitive. They benefit from recessions. In a recession or a economic crisis, you want to have your entire asset allocation in bonds. Over the long term, a number of the endowments, actually, which we'll get into later, have very little of their allocation into bonds because they found over a 20-year period, bonds actually do not perform as well, and they've had their treasury bills, which are the least risky, are priced the most efficiently in the market, and over the long term have the least favorable return profile. And that's a disadvantage of bonds, is that their returns really only marginally exceed inflation. So then, there's real assets, which, we are very highly allocated to real assets. We think real assets benefit from inflation. On the downside, there can be volatility in the commodities market. We saw oil go from 140 to 40 in the space of a few months. So you really have to be prudent in your use of leverage when you're investing in real assets, because the short-term volatility can create havoc if you've got a levered portfolio. The other disadvantage of real assets, which came into play in the GFC, is they're usually illiquid. So you want to plan for your family and make sure that the liquidity profile of your real asset allocation is prudent. And then the long short, as we said before, we think hedge funds are a much better asset class than mutual funds. We think, although a number of the disadvantages, and we saw this during the GFC, a number of the hedge funds aren't hedged. They should be long certain companies that they think are going to outperform the industry and shorting an index. And if they were really hedged and they were long certain companies that they were going to outperform and short indexes, they wouldn't have done as poorly in the GFC. Unfortunately, a number of hedge fund managers, as we've seen, are not hedged. But certainly you can do better with a long-short strategy than you can with a long-only strategy. Now, this chart is very interesting, and I think we could just spend the next hour just analyzing this chart if we had the time. And what this chart is an argument for is it's an argument for comprehensive diversification. And what it basically shows you is it shows you returns over a 10-year period, and it shows you which if you look at 2009, emerging markets outperformed. If you look at 2008, the GFC, global bonds outperformed. If you look in 2006, real estate outperformed. So if you look over in 2002, commodities outperformed. And if you look over the cycle, what you find is the asset classes that perform well in one year sometimes don't perform well in another year. Emerging markets that was up 40% in 2007 was down 53% and was a worse performer in 2008. So it's a real argument for having your portfolio diversified and not over-allocating to any sector, and having a diversified portfolio that includes real estate, that includes emerging markets, that includes small cap, that includes value, that includes bonds, and is comprehensively diversified. And this is a great chart for any of you to kind of study later. And the other trend that we think comes out of here that you'll see later is the past few years we think, and we haven't really allocated to this sector, but emerging markets is starting to look like it's a trend that's going to outperform. So what is the endowment model? A number of family offices in the United States have based their family offices off the endowment model, and it's become very popular. And a number of the larger families now, proud to boast that they're using the endowment model. The endowment model is essentially based on the four-class model with a much lower allocation to bonds. And we don't think that's very prudent for families. We think the endowment model is great. We think, and we certainly have a high allocation to bonds. And we think that to be prudent in managing wealth over the next generation, you really need to have a decent allocation to fixed income. The endowment model, similar to the four-class model, focuses on a diversification of assets. It has an extremely large percent of the allocation in alternatives and in real assets versus a traditional stock and bond portfolio. Harvard and Yale are probably the two largest endowments that everybody looks to follow their lead in terms of asset allocation. Harvard has about $27 billion under management, and Yale has about $16 billion. The endowment model is based on a few key principles. It's based on the principles of diversification, which we spoke about earlier on the chart on the last page. It's based on higher equity allocations, very little fixed income allocations, which I've said before I do not think is a good idea, and then a very large allocation to alternative assets, including hedge funds, private equity, real estate, real assets, timber, and then they really look to exploit the liquidity risk, as they believe illiquid assets have higher returns. And they do deep due diligence on managers. So they have a team that has, that really does deep due diligence onto fund managers. Why do family offices like the endowment model? What's all the buzz about the endowment model anyway? I think the reason why people follow the endowment model is it's proven from a return perspective. Yale Endowment has annualized returns of just under 12% over the past decade. And likewise, Harvard's endowment earned annualized investment returns of 11.9% over a 20-year period. So they've really outperformed traditional benchmarks and the traditional two-class model. Harvard, of course, had very poor returns in the GFC, which have hurt their short-term returns. And both Harvard and Yale lost about 24% in the GFC, and Harvard lost about 27%. So they really didn't do well in the GFC, and that's largely due to their lack of an allocation to the bond portfolio, to fixed income interests, and also because they had a very highly illiquid portfolio, and that hurt them. And we don't think that's a good idea for families. So what is the asset allocation of Harvard and Yale? The asset allocation is highly weighted to alternatives. It's diversified with allocations to emerging markets increasing and allocations to domestic equities increasing over time. You can see here in the chart below, Yale, for example, had 24% in absolute return, 7% in domestic equity. Only 4% of the total asset allocation was in fixed income. And we think that's a terribly low number, and is why they got hurt in the GFC, and is something that, we think for any family that had 4% of their asset allocation in fixed income would really have to think clearly about what they're doing. So we wouldn't recommend copying that part of the asset allocation. And then you can see they've got 10% in foreign equity. They've got 24% in private equity and 32% in real assets, which gets me on to my next point, which is they have a very high allocation to illiquid assets, very much higher than most family offices would have. Harvard had about 13% in 2010, up from 11% in 2008 in private equity. And they had another 26% of their total allocation in real assets, including commodities, timber, agricultural land, and real estate. Yale had 24%, which is up from 20% in 2008 in private equity, and 32%, which is up from 29% in 2008 in real assets. So that means 56% of their total portfolio is illiquid, which is something to really, it's surprising to a lot of people, because a lot of people would not think that Yale and Harvard's endowment is, the majority of it is in illiquid assets. We do think they've got the trend towards real assets is one that is prudent. We think it's a hedge against inflation. We do think the United States is going to have tremendous inflation. We think the endowments are onto a trend there. And a lot of real assets also have high cash flow and a low correlation to the general market. And we're not bullish on the overall U.S. equity market. So it could be this high allocation to real assets over the long term helps the endowments have a positive return. So why do they have this high? What is the rationale for this high liquid percentages? When you look at the returns over the past 20 years, and I think Harvard and Yale have done a study, what they found is that private equity over the long term has outperformed every other asset class. And if you look at the charts below, you can see returns across asset class. You can see returns in private equity, returns in real assets, returns in foreign equity, returns in fixed income, which are clearly the lowest, which is why they justify having such a low allocation to fixed income. And then absolute return. And what you find is private equity really does, over the long term, the illiquidity premium investing in private equity really does help increase the performance. So Harvard's natural resources portfolio has returned 13.3% annually since inception. Yale's real assets has produced a 13.5% annualized return over 10 years. And private equity has earned a 25.8% return over 10 years, which is pretty good, and that's why they justify over the long term having such a large allocation to private equity and real assets and other illiquid assets. So what about the hedge fund sector? Most family offices in the United States prefer hedge funds over private equity. We all have a much higher allocation to the hedge fund sector than we do the private equity sector. So why is that? I think that is, if you look at this chart below, you can see how, compared to general market returns, if we were to invest in the S&P or the Dow Jones or the NASDAQ, or to select long-only equity managers, we wouldn't be doing as well. And the ability of fund managers to go long and short the market, the fact that you have, the economics of hedge funds these days paying 2 and 20 really leads to a lot of the smartest brains on the streets, on Wall Street, heading to hedge funds. And so you have the combination of the ability of a manager to go long and short the market, the flexibility of them to change their positions, on a minute-by-minute basis, and the fact that you have all the intellectual capital, globally heading to the hedge fund sector, we think has led to outperformance versus the general equity markets. And you've seen a number of families have been increasing their allocation to hedge funds versus the general equity market. Another trend that we think has been emerging, and it's not something that we've really capitalized on, is you're starting to see emerging markets, and you're starting to see a number of families allocate to emerging markets. And interestingly enough, I was recently at a meeting with a number of other prominent family offices globally from all over the world. And, another prominent billionaire a US-based family office commented that him and a number of colleagues are 50% invested in the United States and 50% invested overseas. And there was also a very prominent Brazilian family there. And he said, well, we're 80% invested in Brazil and 20% invested overseas. And we all commented that, 10 years ago, any US-based family office would have been 80 to 90 or sometimes 100% invested in the United States, and it would have had a very low allocation to emerging markets and overseas markets. And now what we're seeing is a flip where the families in Brazil, which is an emerging market that's likely to outperform and have tremendous economic growth over the next 10 years, are really finding that they're investing predominantly locally in their economy because the returns that they can generate are tremendous. And they're allocating less to the United States and Europe and other more developed markets. And we think there's really a trend right now for families to diversify their wealth globally and seek returns in emerging markets. And the balance sheets of these emerging markets are actually starting to look better than the heavily indebted industrialized countries such as the United Kingdom, Europe, the United States, and Japan. So we're seeing that if you look at the balance sheets, and we've all seen with the Greek financial crisis, et cetera, a number of the developed countries currently, including the United States, have a tremendous amount of debt. We don't know how the United States is going to pay off this debt. And so the returns that you can generate in these heavily industrialized countries and the economic growth is not as great as the returns that you can generate overseas. We've seen you get a double return currently not just based on the income generated from the investment, but traditionally right now you're getting a currency appreciation. And I think if you look at the chart below, it's very indicative of that, because you can see in certain markets such as Brazil, when you look at the total return that was one of the highest, it was at 16%. Then you look at, say, a country like New Zealand or even Australia, a lot of the return, 6% of the return was based on currency appreciation. And the same thing in Europe. And our family office, rather than buying Treasury bills, we own Eurobonds, and we've had a Eurobond position for the past few years. And it's done very well, not just based on the fixed income interest return, but based on currency appreciation. So we've been, kind of very pleased with our Eurobond position, and it's really benefited from a decline in the dollar. And we feel that the U.S. dollar is going to continue to decline over the next foreseeable future as the U.S. continues to have, tremendous economics problems. They've sent most of their manufacturing overseas. And we think this trend of emerging markets growing and the United States and other developed markets having troubles dealing with their debt is going to continue. We haven't totally capitalized on this in terms as other families have, other than just having a Eurobond position, which is fairly conservative. So what do we do as a family office? We believe in investing around macro trends. So I think if you take an analogy of a surfer, if you're going surfing, and if you're surfing on a calm beach, you're not going to catch many waves. I think if you look at the picture on the left, you can see the surfer is not really able to show his skill. He's sitting there waiting for a wave. And if you look at the surfer on the right, he's got the wave at his back, and he's really surfing a huge wave. And I think this can be compared to investing. You really want to have, if you're sailing or if you're surfing, you want to be sailing with the wind at your back, or you want to be surfing with a wave at your back. So you really want to be investing in the areas that are going to be macroeconomically outperforming. So our theory is essentially that commodities are going to outperform. And if you look at the chart below, you can see the S&P 500 versus oil, gold, silver, and other commodities. And what you notice is that gold has certainly outperformed. We were buying actually gold around $300 an ounce. We were buying oil around $10 a barrel. So we've been very long-term believers that oil, gold, and commodities are going to outperform. And fortunately, so far, we've actually been correct in that thesis, and we think that trend is going to continue, and we'll get into that a little bit later. So what are these macro drivers? We think oil and other commodities also fall into oil, gold, uranium, steel. A number of commodities also fall into this category. We seem to have an expertise in energy, and so have focused more on, detailed analysis of the oil and gas market. But if you look at the macroeconomic drivers behind oil, what you find is the United States right now is consuming about 25% of global oil production, which is about 20 million barrels a day of the 85 million barrels produced. Yet the United States population is around 303 million, which is about 5% of the world. So we believe that the growth of China and India is really going to strain the global supply of energy. China consumes about 7 million barrels a day with a population of 1.3 billion, which is 20% of the world population. So China has seen oil consumption grow by 8% yearly since 2002. So it's doubling from 1996 to 06. Growth in auto sales has been about 20%, and then with an average annual growth forecast of 10%. China has about 160 million motor vehicles on the road, and they're projected to have more cars than the United States by 2030. So we really feel that this macroeconomic picture of China and India growing is going to create a tremendous demand. There's not enough resources in the world with them growing aggressively. And actually some of our family members right now are stationed in Dubai and Abu Dhabi and have just signed a joint venture with the royal family of Abu Dhabi to do various oil-related projects. And one of the interesting things we see being in the Middle East, which is the largest oil producer in the world, and dealing with the OPEC countries, is interestingly enough, Abu Dhabi has TAQA, which is an Abu Dhabi government vehicle to own foreign oil reserves. So if Abu Dhabi, which is one of the largest producers of oil, feels it's necessary to create a government-owned oil company to go and buy oil reserves in Canada, it's a clear indication that we really don't have enough global reserves. And this picture really shows you, here's a chart of all the Middle East, Russia, Canada, Mexico, and Africa. And if you look at worldwide, oil discoveries have been less than annual production since 1980. The costs of finding and developing oil are rising. Saudi Aramco's mature fields are declining at a rate of 8% a year. Guawa, which is the largest oil field in the world and is producing about half of Saudi Arabia's oil production over the last 50 years, is peaked. The second largest oil field in the world, the Burgan field in Kuwait, started decline in November 2005. And likewise, Mexico's giant Cantarell field started depletion in 2006. So what you're seeing is all the conventional oil fields are in decline. So we think the picture of increased demand with declining oil fields is one that's going to result in a tremendous demand for oil as a commodity going forward. And we're just fortunate that we feel that we're very fortunate that we had the GFC, because the GFC really came at the right time when oil was hitting $140 a barrel. Because if it wasn't for that, we were very tight on the supply lines, and it's only because of the global financial crisis, which means on the margin, countries are consuming less oil, which means we have a little bit excess supply, which we think is really a blessing and gives us some time to figure out a kind of a looming energy resources problem. So what's our family investment thesis? Essentially, we believe that we've been in a low interest rate environment that has created certain bubbles, that there's a number of geopolitical events and macro issues. We're very concerned. We're watching very closely the geopolitical issues in the Middle East with Iran. We're very concerned with Iran, Iran threatening to start, World War III. We're keeping an eye on that, and we've had meetings with U.S. government officials to try and, at a number of times when the U.S. was about to go in Iran, to try and stop that from happening, whatever influence we could have there, because we feel that they would cut off the Straits of Hormuz and you'd have a larger problem in the oil markets than anybody could fathom, because most of the oil goes through the Straits of Hormuz, and so you'd have oil supply lines cut off from most of the Middle East. So this is a kind of a geopolitical issue that we're watching, very closely, and we think it could create volatility in the markets if something happened there. We think the U.S. dollar is incredibly vulnerable. We think gold is a very prudent alternative to fiat currencies. The family actually owns physical gold. We have physical gold stored in safes, and as well as allocations to commodity-related hedge fund managers. We think, the U.S. economic woes are just getting worse. I think unemployment is officially around 12% in the United States. Unofficially, the numbers, some people say the number is really more like 22%, because a number of the statistics only include people who've been unemployed for 6 months, and after 6 months or 12 months, because the government rolled over in unemployment benefits, once they fall out of, or if they don't qualify for unemployment benefits, if they owned a business so they don't qualify, they're not considered unemployed. So we think the number is actually a lot higher. We think the lack of domestic manufacturing, increasing foreclosures. We think the United States has sent a lot of business, a lot of the manufacturing jobs. We don't see how these jobs are going to be coming back to the United States with manufacturing sent overseas, with the trend for people to outsource services and technological input out of India. And, a lot of people in the United States are hiring secretaries out of India. They're hiring technological people out of India. They've got Salesforce customer service now. You get on the phone with customer service from Microsoft and you're transferred to India. So we don't see how these jobs are going to come back into the United States. And then, we're also very concerned, and we're close with another family office that is, developing rare earth. And, the United States is very dependent on China for rare earth production, which is needed for manufacturing. Most of our electronics all rare earth is a component that is needed, and China is really the largest supplier of that. And China has been cutting back on their supply of rare earth to the United States, and it's created manufacturing issues for a number of companies who now are not manufacturing as many products locally. So we think these trends are concerning for the United States. We're also concerned about the balance sheets of the United States and other developed countries. I think Australia is in a nice position because it doesn't have the debt of other developed countries. So I think, locally in Australia, in your market, you're very fortunate that the government hasn't put excess leverage on the country, because currently U.S. and other developed countries they're showing the balance sheet characteristics of third world economies. So that's troublesome to a lot of families in the United States. We've seen about $36 billion has left stock market funds in highly indebted industrialized countries, while $45 billion entered emerging market funds. So we're really seeing a trend of people moving their capital out of the United States. And certainly there's less foreign capital coming into the United States because the regulatory environment has been changing, and the tax laws have been becoming more and more unfavorable for people to be located in the United States for tax purposes. So we really feel that the growth of emerging markets is creating a commodity boom. We think the tactical opportunities right now are in gold. We think they're in commodities. That would include all commodities, oil. A lot of people said water is going to be the next oil. We're a believer in that. We haven't found a way to monetize that, but we're a believer in that. And we think, natural resources are also a sector that, the whole natural resource sector is going to outperform over the next 10 years. We also think emerging market currencies, fixed income equities are a place to allocate capital, and we haven't really done enough there either, other than in portfolio companies that we have a majority interest in. We've encouraged to do business in emerging markets. So our family investment thesis really is we emphasize capital preservation And I think I kind of started off on that point that, we don't follow the endowment model. We're more closer to the full class model than the endowment model, in terms of we believe you need to have, a decent allocation to fixed income. Most of that, a lot of our fixed income interests are in euro bonds, just because we think it's going to outperform, local treasury bills. We don't have leverage on our public equity portfolio. Actually, interestingly enough, even recently, and even 2008 during the financial crisis, believe it or not, we still had some of the investment banks pitching us 3-to-1 non-recourse leverage on a fund of funds portfolio, and which is quite tremendous, because just so you understand the math, it's non-recourse leverage. Traditional leverage on a fund of funds portfolio means, if you put $100 million into a fund of funds portfolio and you've got 3-to-1 leverage, so you've got $300 million of leverage and the fund is down 20%, you're losing $80 million. So this was non-recourse leverage, which meant we get the 3-for-1 leverage, and if we're down 20% on a fund of funds portfolio, we lose $20 million, and the bank loses $60 million. So they were taking the risk of the leverage on their balance sheet, and we were getting the upside of the leverage on the return. So it was an interesting deal. We didn't even feel comfortable with that, because we're so conservative that when I looked at the math, I said, okay, well, if we have a flat year or down year, even just a flat year, I've got to deal with the cost of debt, and even the cost of debt is 5%. And take $100 million as an example for numbers. We're losing additional 15% if we're down 5% or if we're flat. We're usually losing additional 15% on the cost of debt, and just that amount of risk to us was not palatable. But a number of families, unfortunately, did take on these levered products and these structured products that the banks were offering. They did very well look, if you can get 3-to-1 leverage on a fund of funds portfolio and you're making 20% a year, for a while you're really levering your return portfolio. We just have our view is we want to preserve capital, we want to manage wealth for the next generation, and we'd rather lose a little bit on the upside and know that when there's a financial crisis or things are not going well, that we still maintain wealth. We don't allocate to certain asset classes. Like I said, we think the financial sector is over-levered. We think we didn't have any investment banks in our portfolio going into the crisis. We actually kind of had some foresight there, which was fortunate. We also don't have that many real estate investments other than family homes. We've got very few generalist hedge fund investments. So our portfolio has really been to find the sectors of the market that we think are going to outperform over the next 10 years. And right now, and this has been our thesis for probably the past 10 years, we really believe that's going to be energy, that's going to be alternative energy, it's going to be commodities, it's going to be natural resources, it's going to be gold, and it's going to be the whole resources sector, the mining sector, the whole resources sector in general. So what we've done is we've selected hedge fund managers and private equity fund managers within the sector that we feel that we understand. We've also got a direct investment portfolio in commodities. One of the family members runs a commodity-related and energy technology company. So we've got which started off more as an investment, so we've got operational expertise in-house in the family. And we feel that we can outperform, when we understand the sector. It gives us a better ability to evaluate managers within a sector that we understand. And we think it's a synergistic investment approach. It makes us a value-added limited partner. And in many circumstances, for example, there were a number of hedge funds we were invested in, and we happened to get the first call. We were meeting with some of the Geneva private banks, and they got the first call on a few years ago, one of the Saudi refineries, I think it was Abaquerque, had a malfunction. And it was significant. And the news hadn't hit the wire. And so we called up a number of the hedge fund managers we were invested in and said, guys, we think you should allocate your portfolio accordingly. This is the news. It hasn't hit the market. We're meeting with some of the Genevan, some of the private bankers that deal with certain royal family interests, and expect this news to come out. We assumed it was coming out that day. I think the news came out, a few days later. And basically, we were a very value-added limited partner to those managers because we gave them news ahead of the market, which not very many limited partners do. And that works both ways. Sometimes they'll know that we've got certain positions in our direct investment portfolio, and they'll call us up and say, we know that, you guys own U.S. Steel, and we just met with management, and it's also in our portfolio, and we've exited, and this is why, and speak to our analyst. And because we're so long-term in nature and we're so busy, we don't always monitor our positions on a daily basis the way a hedge fund does. So we find it's a relationship that goes both ways and ends up being very synergistic for both parties. So with that, I think we're just going to open it up for questions and answers, and I'm happy to take questions.
Thanks, Candice. One question we have from Ross Illingworth. He asks, have you seen any evidence of family offices stress testing the capital value of their investment portfolios with the potential impacts of rising inflation and interest rates?
Okay, so the question was, have I seen any indication of family offices reacting to interest rates or inflationary? Sorry, I couldn't hear the question properly.
I'll repeat the question. Have you seen any evidence of family offices stress testing the capital value of their investment portfolios with the potential impacts of rising inflation and interest rates?
Look, I mean, I think a number of families are very concerned about rising inflation and rising interest rates. In the United States, we don't think interest rates are going to rise that much. I think families that have a high real estate portfolio in the United States probably, haven't stress tested their portfolios enough, and just because they don't believe. We know a number of families here in the real estate market, and they don't believe that interest rates. They don't believe the government is going to raise interest rates because the U.S. is so over-levered. So I think locally, we think that a number of families they haven't stress tested, they haven't run sensitivities on a high interest rate environment and what that would do for their portfolio. Inflation, a number of people are concerned about inflation and deflation. And, families, we have arguments about this on a regular basis, whether we'll be in an inflationary or deflationary environment. And, a number of families are allocating to real assets to counter inflation. And I think that's the best way that somebody could allocate capital if they really believe we're going to be in an inflationary environment. And certainly there are statistics to prove that could be the case.
One more question we have from Jerome. If you think that inflation is on the way, how does that affect your allocation to fixed income? Are you shortening bonds at all?
We're not, because you really don't know. I mean, as much as we think inflation is on the way, there are people that argue no, deflation is on the way. And when you listen to experts on deflation, you can walk out of the meeting saying maybe we are going to be in deflation. So our view is really, as I said earlier, if you look at the full class model, is really you want to be allocated to all sectors. So we want to have an allocation to fixed income, just like we want to have an allocation to real assets. We have a higher allocation to real assets than we do to fixed income. And that's how, our belief that, we're in an inflationary environment, that's how we we speak with, where we allocate our capital, and we are much highly allocated to real assets, than any other asset class. But we still, just to be prudent and conservative, we still need to have allocations to fixed income.
Okay, thanks so much, Candice, for answering those questions, and thank you very much for your presentation. We have recorded this session, and a link will be made available to you within the next half an hour. You'll find this on the webinar page. Thank you once again.